Process costing is a continuous costing system used to accumulate and assign production costs, where identical or homogeneous products are manufactured through a sequence of standardized production processes. Unlike job costing, which accumulates costs for individual customer orders, process costing averages production costs across large numbers of identical units passing through successive production departments. The method is particularly suitable for mass production industries where products cannot be individually distinguished during manufacture. Process costing provides management with reliable unit cost information for inventory valuation, pricing decisions, budgeting, cost control, and performance evaluation, while supporting efficient management of continuous manufacturing operations. Characteristics of process costing. Process costing possesses several distinctive characteristics that differentiate it from other costing methods. Production occurs continuously rather than in response to specific customer orders, and units produced are identical or substantially homogeneous. Manufacturing typically proceeds through a series of sequential production processes or departments, with each process adding value to the partially completed product before transferring it to the next stage of production. Costs are accumulated separately for each production process over a specified accounting period rather than for individual units. At the end of the period, the total process cost is divided by the number of equivalent completed units to determine the average cost per unit. Since individual units cannot be separately identified during manufacture, cost averaging becomes essential for inventory valuation and cost measurement. Consequently, process costing simplifies accounting procedures while providing useful management information for large-scale production environments. Appropriate applications of process costing. Process costing is appropriate where production is continuous, repetitive, and standardized, producing identical units in large quantities. It is widely applied in industries where products pass through multiple processing stages and individual units cannot be separately distinguished. Typical applications include oil refining, chemical manufacturing, cement production, food processing, sugar refining, paper manufacturing, textile production, pharmaceuticals, plastics, beverages, paint manufacturing, steel production, and electricity generation. For example, a petroleum refinery continuously processes crude oil through distillation, cracking, and blending processes, producing homogeneous products such as gasoline and diesel fuel. Similarly, a paper mill converts wood pulp into continuous rolls of identical paper through successive production stages. In such environments, process costing provides the most practical and efficient method of assigning production costs. Normal losses, and abnormal gains. An important feature of process costing is the treatment of production losses. During manufacturing, some material losses are unavoidable because of evaporation, shrinkage, chemical reactions, spoilage, or machine operations. Such losses are classified as normal losses. A normal loss represents the expected and unavoidable reduction in output arising under efficient operating conditions. Since these losses are anticipated, their cost is absorbed by the good units successfully produced. If normal loss units possess scrap value, this value is deducted from total process costs before calculating unit costs, thereby reducing the cost assigned to completed production. By contrast, an abnormal loss occurs when actual losses exceed expected normal losses because of inefficiency, machine breakdowns, operator error, poor quality materials, or unexpected production problems. Abnormal losses are avoidable and should therefore not increase the cost of normal production. Instead, abnormal loss units are valued at the normal production cost per unit and transferred separately to an abnormal loss account before being charged against the income statement as a period loss. Conversely, an abnormal gain arises when actual losses are lower than expected normal losses. Improved efficiency, superior materials, or enhanced production methods may reduce losses below anticipated levels. Abnormal gains represent favorable operational performance and are recognized separately by crediting the abnormal gain account while adjusting process costs accordingly. Byproducts and joint products. Many manufacturing processes generate multiple outputs simultaneously. These outputs are classified as joint products or byproducts, depending upon their relative economic importance. Joint products are two or more products of significant commercial value generated simultaneously from the same production process and common input materials. Before reaching the split-off point of separation, joint products share identical production costs that cannot be separately identified. Examples include petrol, diesel, and aviation fuel obtained from crude oil refining, or beef cuts obtained from livestock processing. In contrast, byproducts are secondary outputs generated incidentally during the production of the principal product. Their commercial value is relatively low compared with the main product, although they may still generate useful revenue. Examples include sawdust from timber production, molasses from sugar refining, or animal hides obtained during meat processing. Valuation of joint products and byproducts. At the point of separation, joint production costs must be allocated among joint products for inventory valuation and profitability analysis. Several allocation methods exist, although the sales value at split-off method is among the most widely used. Under this approach, common production costs are allocated according to the relative sales values of each product at the point of separation. Alternative allocation methods include physical units, net realizable value, and constant gross margin approaches, depending upon management objectives and product characteristics. Byproducts are generally valued using simpler approaches because of their relatively low significance. Common methods include recognizing their net realizable value as miscellaneous income or deducting expected byproduct revenue from the total production cost of the principal product before calculating unit costs. This treatment simplifies accounting procedures while reflecting the limited economic importance of byproducts. Evaluation of further processing. After the split-off point, organizations must decide whether products should be sold immediately or subjected to further processing to increase their market value. The appropriate decision depends entirely upon incremental analysis, comparing additional revenue generated through further processing with additional processing costs incurred. The decision rule is straightforward. If incremental revenue exceeds incremental processing cost, further processing increases profit and should be undertaken that if incremental processing cost exceeds incremental revenue, products should be sold immediately at the split-off point. Importantly, joint production costs incurred before separation are sunk costs and therefore irrelevant to the further processing decision because they cannot be avoided regardless of subsequent action. Overall, process costing provides an effective costing system for continuous manufacturing industries by averaging production costs across homogeneous output, appropriately accounting for production losses, allocating joint costs, and supporting managerial decisions regarding further processing. Its systematic approach ensures accurate inventory valuation, cost control, profitability analysis, and strategic decision-making in large-scale production environments.